Good morning, everyone. Thank you for joining us today. My name is Neetu Kumari, and I'll be the host for today's webinar. Today, we would be talking about internal control and their impact on financial audit outcomes. Before we start dive into the session of webinar, let me introduce my company and we would be taking it forward. ACME Group. ACME has established itself as a trusted tax and financial solution provider across the GCC region and Egypt. We are committed to delivering high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build long-term relationship with our clients. Our exceptional team consistency delivers value efficiency, making us the preferred service provider in the region. Now, let me introduce our esteemed speaker for today's webinar, Mr. Taimur Khatak. Mr. Taimur brings over 8+ years of hands-on experience in auditing, tax consulting, financial reporting, and compliance. Taimur has worked with accounting systems like SAP, QuickBooks, Zoho Books, Tally ERP, known for his meticulous approach and ability to connect with the clients. He has led the audit engagement for several banks and financial institutions in UAE. With a background in international accounting and a proactive mindset, Taimur help organizations strengthen financial control, stay compliant, and make informed financial decisions. So before we start, I encourage my audience to to share your questions in Q&A session. This will help us create an interactive session and ensure that you gain maximum value in today's webinar. Your participation is essential to the success of this webinar. I would like to hand over the stage to Mr. Timer to begin the webinar. Thank you.
For today's webinar, which is about internal controls and their impact on the financial audit outcomes, for the table of content, for the table of contents, we will start with the introduction. What is internal control? What makes it so important and crucial for the businesses? The objectives, what is the control environment? How to assess risk regarding control activities? How to make internal controls more and more effective, integrating internal controls with the corporate strategy, challenges in maintaining effectiveness in the control systems. This is the first slide. What are the internal controls? So basically, internal controls are a set of systems and procedures which are there to ensure that the integrity of the financial reporting and financial and accounting information is maintained. It promotes accountability and prevents fraud. It is very much integral to all parts of the business operations if effective financial reporting is desired. Why internal controls are crucial? As I mentioned, that it prevents misstatements and fraud, but not only that, it prevents the business from misstatements and fraud before it even happens. So it kind of like highlights the red flag areas where the management should focus more, and as a result, it can be prevented. It enhances and promotes accuracy of financial reports and all of the financial data. Provides transparency to the stakeholders, shareholders, and all of the stakeholders that there is a system which is monitoring everything. So when it comes to the objectives of internal control systems, reliability of financial reporting, it ensures that financial reports are accurate and free from material misstatement or errors. It helps the businesses being compliant with the regulations and laws of the country, aligning business practices with the legal requirement, efficiency and effectiveness of operation. It helps safeguarding the assets of the company and to maximize the output or optimize resource use. So with the same assets, the maximum output can be obtained. So there's a COSO model which has been developed. It's a widely adopted framework for internal controls. It has basically 5 steps. One is internal control environment. So the control environment needs to be there. Then the risk assessment. So in the control environment, it should be effective enough to assess the risk. The third part is control activities. So it should also be effective enough to see whether there's any activity which is deviating from the standard. uh, Information and communication. There has to be even if there is a red flag in the internal controls or something, but if it is not communicated and informed to the senior management, then it will not be helpful. So there has to be information and communication uh, as much as possible. And the last step is monitoring activities. It helps monitoring the overall uh, policies and overall practices in the company. It is, the overall tone which is set by the senior management regarding the importance of internal control. Um, if they are being particular, the and it's like it's like a tone of the business from top to bottom. So if the senior management is following all of the internal controls, automatically it will go down till the lowest level of the organization as well. So there are 4 points in it. Integrity and ethical values. The team which is operating in the company needs to be trained and needs to be reminded about the ethical and integrity of the individual regarding professionalism. So for that, there could be some training sessions which are held maybe on a monthly or a quarterly basis. Then commitment to competence. So the individuals who are applying the internal controls, they need to be competent enough. The third point is organizational structure and governance. So there has to be a proper set of hierarchy in the company, and there has to be certain levels of approval before any decisions are being made or taken. So the structure or the hierarchy in the company helps implementing the internal controls. Assignment of authority and responsibility. So the more authority you have in the company, the more responsible your position is, and the more responsibility you have. So the authorities and responsibilities work together. So while applying internal controls, we need to see who has how much authority, and he should be given the same responsibility in application of internal controls. So when it comes to risk assessment, identifying potential events that could affect the achievement of business objectives. Um, so we need to identify risks. All of the risks could be internal and external. So when it comes to external risk, uh, they need to follow the SWOT analysis. They need to see their strength, weaknesses, opportunities, threats. When it comes to internal, they need to maybe do the test of controls and see whether the controls are being effective or not. Um, Assessing risk, impact, and likelihood. So they need to make sure. So if there is a risk of control or a threat of control not being effective, then they need to measure that, what is the impact of the risk and how much is the likelihood of the risk. Then they need to manage risks through mitigation or transfer. With this, this is the time for our first poll question. The first poll question is, do you believe that a company can effectively manage its financial risks without a formal risk assessment process in place? The time is 30 seconds and it starts now. 70% people have answered correctly. We cannot, I mean, if there is no formal risk assessments, it's 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 not possible to manage the financial risks. So when it comes to control activities, there are specific actions taken to mitigate the risks which have been identified. So one is segregation of duties. So in any business, there has to be some certain segregation. So for example, let's say each individual has a certain JD and should only be held accountable for his job. And also he should not interfere in the role of another person. So there has to be segregation of duties. Authorization and approval processes. If so, for example, let's say there is a procurement department in the company and they need to make a purchase, but if the purchase value is has increased a certain threshold, then there has to be some approval which has to be taken by some senior management, or otherwise, if it's lower than that threshold, then maybe just the reporting manager should approve it. But there has to be like a authorization and approval process. There are some physical controls. So when it comes to physical controls, we talk about locks, access restrictions, um, like the physical locks. The fourth is reconciliations and verifications, which are like manually reconciling and verifying the numbers every day, weekly, or on a monthly basis to see that um, everything is on the same page. So when it comes to information and communication, systems for generating and communicating financial data to the relevant stakeholders, it has to be timely and accurate information, because even if the information is passed, but it's not on a timely basis, then maybe it's of no use. So the information needs to be communicated on a timely basis. Then the information needs to be clear, and uh, clear communication channels, maybe through email. Uh, Accessible information for decision makers. The senior management who's going to make the decisions on the basis of the information, it needs to be accessible to them, and it needs to be in a form where it is easy for them to understand. So when it comes to monitoring activities, ongoing assessments of internal control system effectiveness. Um, there is regular internal audits. So if the company is having an internal audit function or internal audit department uh, in-house, then it's like an ongoing process, and it's like a continuous check. But if they don't have the internal audit function in-house, then they can outsource it, and maybe on a monthly or a quarterly basis, they can get the internal audit reports or internal control, which will help them see the effectiveness of internal controls as well. So the second is periodic management reviews, which are sort of interim reports. Um, Third is external audits and inspections. So external audits are normally done after the year end of the business. Um, it is one way to monitor activities also. With this, we have reached to second poll question for the audience. Do you think internal controls are sufficient for identifying all potential weaknesses in a company's internal control system? Your options have been shared in chat box. You guys can see and answer. Your time is 30 seconds and it starts now. The time is over. 60% people have answered as they are helpful, but must be supplemented with continuous monitoring and management reviews, which is the correct answer. Because internal controls are helpful, but I mean, just internal controls alone cannot address all the gaps. So when it comes to financial reporting risks, it can be, it can lead to loss of investor confidence, regulatory penalties, reputational damage. So first of all, if the numbers are not correct and there's some misstatement in it, of course, not just the investor but all of the stakeholders, their confidence will be lost. When it comes to regulatory penalties, there could be some penalties from FTA, which, for example, let's say if the financials are not showing the accurate numbers, that means the tax reporting which has been done, the tax amount which has been reported to the government is not correct. And it will also damage the reputation of the company, and there could be penalties which are applied from the FTA or something. Um, Second is misstatements. It depends. Misstatements can be categorized in two types. One is intentional and one is unintentional. So intentional misstatements can be avoided by having internal controls, but unintentional, um, there is still a risk, but that risk is up to some extent, it is reduced when effective internal controls are there. Third is, if someone is involved in fraud, um, that risk will always be there, and everyone needs to be vigilant about it. Um, the last is operational inefficiencies. So, of course, if there's operational inefficiency, there has to be some uh, risk which is related to the financial reporting as well, if the operations are not effective. When it comes to fraud, it needs to be prevented and detected. Uh, For prevention, employee background checks can be done, regular financial reconciliations. There has to be strict segregation of duties. So, for example, let's say if there is uh, someone at the cash till, that means one person is counting the cash and one person is recording the cash. So there has to be segregation of duties. Two separate people need to be there to do two different jobs. Uh, this was all related to prevention. When it comes to detective controls, there has to be some audit trails. Um, so for every entry or transaction which has been entered in the system, there has to be like a trail who entered it. So if there was some mistake in it, who corrected it, at what time he corrected it, by what amount he corrected it. So it can be seen through. Monitoring and reporting suspicious activity. So if there is any suspicious activity which has been detected by monitoring, it needs to be reported. When it need, ultimately both prevention and detective controls, they lead to corrective controls or corrective measures. For that, investigations and disciplinary actions are taken. Or must take place. So once it has been reported to the senior management, the investigations will be done, and if disciplinary action is required, it will be taken. So when it comes to authorization and approval, uh, delegating authority based on levels of responsibility. Uh, so the higher the authority, the higher the responsibility. When it comes to authorization, ensuring that transactions and activities are approved by appropriate personnel before execution. As I mentioned earlier, in the case of, for example, let's say a procurement department, if they're making, let's say, a purchase of which is less than 50,000, so maybe a reporting manager is able to approve it. But if, let's say, if it's more than that, maybe a director approval is required. But let's say if it's more than 1 million, maybe managing partner's approval is required. So something like that. But there has to be some certain slabs for approval. When it comes to approval of financial transactions, ensuring that payments, purchases, and other financial decisions align with company policies. This is the time for third poll question. Is it possible to maintain an effective internal control system without having a clearly defined approval hierarchy? for financial transactions. Your time is 30 seconds and it starts now. The options have been sent in chat box. Okay, the time is over. 77% people have answered it correctly. The answer was option B. No, a defined approval hierarchy is fundamental to internal control effectiveness. Yeah, so when it comes to segregation of duties, dividing, it's basically like a division of tasks among multiple individuals to prevent anyone from having control overall aspects of the financial transaction. Let's say if one person is collecting cash, one person is counting cash, and the same person is depositing cash or recording cash. That means basically the whole cash cycle he is managing. So there's no one else. So let's say if he doesn't have the professional objectivity or integrity, then there is a big threat of internal control ineffectiveness. So basically, when it comes to segregation, it's like division of tasks. One person approves transaction, another records them. This is a basic example. One person manages asset, another oversees the related records. This is another very good example. So how to make internal controls effective? Uh, for making internal controls effective, safeguards of it has different aspects. So for safeguarding physical assets, it includes cash, inventory, and equipment. For that, secure storage of cash and inventory. When it comes to uh, physical locks, we can lock the access to financial systems and sensitive data. Uh, then we can also install some CCTVs and security systems when it comes to physical assets and their protection. So second is benefiting from using technology and automation and internal controls. It increases the accuracy and efficiency. Automated checks for errors and inconsistencies, streamlined reporting and analysis. So, the basic examples are some ERP systems, financial softwares, QuickBooks, even the Power BI. What happens is if there's any anomaly or if there's any transactions which is not in a usual course of the business, it automatically gets highlighted as long as certain commands are entered. The third is reconciliation, comparing different sets of records to ensure accuracy. We can go for the reconciliations for bank reconciliations for bank accounts. We can do the inventory counts, physical inventory counts as well. Sales and accounts receivable confirmations can be obtained also. So this is the time for fourth poll question. Can automated internal control systems completely replace the need for manual oversight and employee involvement in financial controls? The time is 30 seconds and starts now. Kindly find the option in chat box. Okay, so the time is over. 58% people have answered correctly. The correct answer was option B. No human judgment is required for exceptions because there are always exceptions and anomalies and strategic decisions, and humans have the ability to oversee things. So human involvement is a must. So when it comes to integrating internal controls with corporate strategy, we need to ensure that internal control supports the organization's strategic goal and the long-term goal. So we need to make sure that the long-term goal is aligned. And when it comes to continuous improvement, adapting internal controls as the business evolves, when the company is moving towards their long-term goals, with time things are changing. With time, the processes in the businesses are supposed to be more and more refined and more auto, the businesses go towards, it's like a process of going towards automation. So as things are progressing, internal controls need to be improved as well, and new internal controls should be adapted. This is the fifth poll question for audience. Do you agree that internal controls should be aligned with companies' long-term strategic goals, even if it requires significant changes to existing processes? The time is 30 seconds and it starts now. The options have been shared in the chat box. 52% people have selected option A and 45% people have selected option C. Option C is the correct answer, as alignment is necessary, but changes should be phased and based on cost-benefit analysis. So basically, ultimately, when they're making a change, they need to make sure that any change they're going forward with is is not way too much costly than the when it comes to benefit. So they need to make sure that the cost is less than the benefit. So when it comes to building a culture of control awareness, employees are often the first to notice control weaknesses or potential problems in the daily operations of the company, encouraging them to report these issues without a fear of repercussions. So the control environment needs to be, or even in the policies of the companies, there has to be something for the whistleblowers as well, when it comes to protection. So, um, ultimately it will encourage them, the employees, to report any weakness or potential problem without the fear of repercussions. Because let's say if I'm reporting something about my senior, and there's no such policy in the company's manual, of course I'll have some certain reservations. Without a clear and accessible policies, employees may not know the exactly what is expected of them or how to properly report control weakness. So for that, there has to be maybe an annual training for employees. So whenever they discover the control deficiency, what should be the next step? They should be well aware of it. The third is internal controls and regulations are constantly evolving. Ongoing training ensures that employees are equipped with the latest knowledge. As we discussed earlier, when leadership consistently demonstrates commitment to strong internal controls by following procedures, reporting issues, and holding themselves accountable, um, as we discussed earlier, the tone of the company is always set at the top. So if the leadership of the company uh, puts or hold themselves accountable and follow the certain procedures, of course, it will trickle down and, to all departments and all hierarchies of the company. Then everyone else will also start following the same. Challenges in maintaining effective internal controls. The biggest challenges are limited resources, complexity of operations, and human error. So when it comes to limited resources, maybe the companies don't have enough number of employees where they can, opt the segregation of duties. So maybe one individual is doing all the jobs. Or in some cases, the nature of the operations is way more complex. But again, for them, then they need maybe not a standard internal control, but they need to customize the internal control as per their situation. The fourth is human error when it comes to following strategies, implementing scalable controls, leveraging technology, and ensuring employee buy-in. So, we need all of us, we know that the technology is something that, um, everyone of us looks up to. Um, uh, we are living in a day and age where if anyone wants to take the advantage in all aspects of the business, but today we are specifically talking about internal controls. So when it comes to internal controls, as we were discussing earlier, when it comes to approvals, we can leverage technology. There are so many accounting softwares when the purchase order is made, it doesn't go through until or unless it has been approved. So it's like, let's say if I'm raising a purchase order, it will go to person A. If it's more than certain threshold, automatically it will go to person B. And when everyone approves it, then we'll move forward with the transaction. So it is also easy for us to apply, in that way. Uh, Thanks, guys. With that, I'll give the mic to Neetu.
Thank you, Mr. Taimur Khatak, for providing such an insightful and engaging session. We would now move on to our live Q&A session. Before we proceed, I would like to let you know that webinar feedback session is now live. We would greatly appreciate our audience. Could you take a moment to give your valuable feedback? Additionally, we would request you to leave us a Google review by simply scanning the QR code which has been displayed on your screen. Your feedback is important to us. Now, let us address the Q&A questions asked by our audience. So, I'll be moving forward. So, there is a question from our audience, Mr. Ahmed. What are the key components of an effective internal control system? So, I would like Mr. Taimur to answer this question.
Okay. So, okay, yeah. So, when it comes to the key components of internal controls, it's not just one. One is having internal control, which, for example, let's say segregation of duties, or maybe monitoring physical assets or doing physical counts of the inventory. The second is seeing whether the control is effective or not. To see whether the control is effective or not, we need to make sure why it was made. So for segregation of duties, for example, let's say if one person is recording it, other person is collecting it, so that means there are two people. But if two people are not doing the job, that means it's not effective. So having internal control is something else, and then doing the test of control is something else. After the test of controls, we'll come to know whether the control is effective or not.
Thank you so much, Mr. Thaimur. I think that answers Mr. Ahmed's question. So let's move to the next question. Can internal control completely eliminate the risk of fraud or material misstatement? This is asked by Mr. Mohammed.
Okay, so it definitely brings down the risk, but saying that it completely eliminates is not true, because I mean, it 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 completely eliminating it is something that requires a lot more than that. But maybe you can say 60-70% is the risk is eliminated if the internal controls are effective and they are in place. Um, but um, overall, like even when it comes to financial audit, it's about reasonable assurance. It's not about 100% assurance. So having a process is something, but when it comes to eliminating risk, you need the staff, you need the involvement of the senior management, you need to leverage technology as well, and you need to do the training of employees when it comes to professional objectivity and integrity. So it's like a set of different things.
Thank you so much, Mr. Taimur, for explaining it so well. So let's move to the next question, which is asked by Ms. Hina. How do strong internal control contribute to reducing audit risk?
Okay, so when it comes to audit risk, that means that there is a risk that there could be a misstatement and which goes undetected. So this is like the basic definition of having an audit risk. So having strong internal controls, because you have the strong internal controls, so the risk of having material misstatement or misstatement for that matter, goes down. And once the risk of having material misstatement or error or fraud goes down, of course, the risk of audit or the audit risk, simultaneously or parallel way, you can say it goes down also.
Thank you so much, Mr. Thaima. So we have another, so obviously we have a limited time. We would not be taking all the questions. So let's move on to the another question, which is asked by Mr. Abdullah. In what ways do auditors rely on management's internal control assessment? So if you can answer this.
Rather than relying on their control or assessment, I believe the auditors need to do the test of controls themselves. And once they do the test of controls, and if they find that the controls are effective, then only they can rely. They should not take the assessment of the management just like the way it is. Um, I think they need to verify it themselves.
Thank you. Let's move on to the last question, which seems to be very interesting. So, how should management respond when auditors identify significant control deficiency or material? So, this question is asked by Ms. Kaur.
So when auditors highlight a significant control deficiency, the management, of course, needs to must dig in and take further details and along not just the details, but along with that, the suggestions that what corrective measures should be taken to make it more effective. And once they get the suggestions from the auditors or the external auditors, be it external auditors or internal auditors, then management should adapt these suggestions. And from the auditor's perspective, they can later inquire also to see whether their suggestions were applied and implemented or not.
Thank you so much, Mr. Taimur, for such an insightful information. I believe this is very useful for our audience. And as we end the session today, a big thank you to everyone in the audience for joining us today and contributing to the enriching experience. Your presence and active participation have truly made this session valuable and impactful. We look forward for connecting with you again in our future webinar. Until then, if you have any further queries regarding excise tax, VAT, corporate tax, please feel free to drop us an email or give us a call, and the contact details are given on the screen. Thank you so much for joining us today.